Good evening, all. It's Sunday night. This is Shay Horowitz, ShogunTrading.com. This is our free weekly newsletter. We talk about the market and so on. So let me get started. First of all, this is a chart of the S&P 500 on a daily basis, daily chart. And this is something I've been talking about for quite a while. If you've been receiving this newsletter for a while, you've seen this chart many, many times. You see the very large double bottom and nice bounce off this support level. And now we broke the 1388, which was a big resistance level. And now we broke the 1400, and not just broke the 1400, we actually stayed above it. We closed above the 1400. This means that we are going to continue on the way up. Let me show you a weekly basis. And you can see that we've been in a very strong uptrend for a long time. Lower tops, nice downtrend, bounced twice, and now we're going to continue this uptrend. We are still above the 200 week moving average, which is the red line, and we're charging up. You have to remember that the market never reflects what's going on right now. The market does not try to mimic the situation right now. The market is an investment market, and therefore always works based on what it thinks is going to happen 6 months to 9 months down the road. What the market is looking at right now is that, yeah, we've been in a recession, and the market basically predicted the recession. It looked at the dive in the economy, but now the market is looking at everything that is happening, and it thinks that recession is going to be over pretty soon, and I think 6 months to 9 months, and then we're done, and that's what the market is thinking as well, and that's why it's coming up right now. We are starting a long-term uptrend at this point, which is a great thing. And the reason why is pretty simple. Think about this as nutrition. You have very nice long-term trends. These are your main meals. This is when you get the most amount of calories. This is where you get the most amount of profits, is when you get these kind of trends. If I look at this, you can see a very heavy meal, lots of calories, heavy meal, lots of calories, lots of trading, lots of profit, lots of trading, lots of profits. But what happened now, over the past few months, actually beginning of 2008, we've been in this range between this and this. Now, whenever you have this kind of a range, it's very, very difficult to get long-term uptrends or long-term downtrends. It's very difficult to get the large trends, because the market is basically all over the place. On a daily basis, it's back and forth. So we have to break out of this range, which is what we're doing right now, in order to get the longer-term trends. Now, when you're trading and you're looking at the market is basically 60% of your trade. Whatever you're trading, the market is always going to be 60% of your trade. It's the guidance, it's the road conditions, it's the overall picture of what you're doing. And you have to adjust your trading to whatever the market is doing. If the market is in a stage of long-term trends, you want to join that kind of trading. You want to also trade on the long-term basis. You want to hold stocks a lot longer. You want to look for the longer-term trends. But when the market is choppy, you want to go for the shorter-term trades, where you are able to make that 2%, 5% in a day, 2%, 5% in a couple of days, and you're out. 2%, 5%, and you're out. And you accumulate these small profits. But the moment that the market breaks out of this range, breaks to 1400, for example, and starts moving, you want to hang on to stocks a lot longer, and you want to look for the more solid patterns and the more solid charts, and you want to flow with it, which is great. I mean, we still have some very, very nice trends. I mean, for example, we called Apple at 134, 38 and went up to 180, but that's completely abnormal. That is not what the market does. Most of our trades, for example, are more like this, where let me give you this on a 60-minute basis so you can see what I'm talking about. Most of them are, buy at 11.26, and then within a day or two, it's up to 12.16. And it doesn't seem like that much, but we do it on a consistent basis. And you do it over and over and over and over, and you're doing pretty well. Now, I want to talk a little bit about last week. There's S&P 500 on last week, and you can see. Let me enlarge it a little bit. This was Friday, so 5.2 was Friday, 5.1 was Thursday, 4:30 Wednesday, 4:29 was Tuesday, and basically the market did not move a whole lot. This is FOMC. This is when they released interest rates right there. You can see that big blimp. And whenever there's big news such as interest rates, the market holds off. Everyone goes to the sidelines. Nobody does anything, and you want to do the same thing. You also do not want to trade when the market itself is all over the place. When the market itself is dangerous, you want to stay out, and that's why we stayed out most of this week, because we do not want to go into all this. And then Thursday and Friday are basically a reaction to interest rates. So kind of a useless week, kind of a week that you want to take a break. You don't want to be so aggressive. Unlike the week before that, where we were very aggressive and we made pretty good money when the market was trading and trading pretty well. Anyway, so that's the market itself. For the next few weeks, I think we're going into an uptrend, and I'm looking for uptrends. I'm looking for bottoms. I'm looking for continuations of uptrends, and I'm looking for stocks that are going to follow with it. Let me go back to a daily chart. And I want to show you some sectors. One of them is the financial sector, and this is one that I talked about even last week, and I gave you this level, 27.25, as an entry point in the financial sector. And you can see that the financial sector broke out of this downtrending channel, and it's starting to come up. So that's one to invest in for the long term. I think they're done, and I think they're going to start coming back up. UIG is just another ETF for basically the same thing. This is another level I gave it, 34.72, and it's doing pretty well. I went up to 37.22. That's 2.5 points. It's not too bad. SSO, that's the ProShares S&P 500, and basically this one mimics the S&P 500, and S&P 500 broke the 1400 and went up, and this one did exactly the same thing. IVV is another one of those ETFs that specializes in S&P 500. Also, 140.25 is the level I gave you last week, and it's still going. 142.61 was high for Friday, so nice 2-point trade. But the reason why I'm showing you all of these is because they are a long-term investment that I think is going to do very well for you. GLD is gold, and I've been talking about this for quite a while. I've been saying that it's ready to come down, and this is anti-inflationary, and it's been working pretty well on the short side. If anyone took the straight on the short side, definitely doing pretty well there. I'm expecting these trends to continue. I'm expecting the market to continue the uptrend, and for our economy to fix itself little by little. And I think it's time to come back to the stock market and invest for the long term, because I think it's I think that's what the market is looking to do. There's the Dow Jones Industrial Average. You can see basically the same thing. Also, long term. Notice that we're breaking right now the 200-day moving average, which is the red line. Now we're going to get some pullbacks, but overall, I think that we're going to see continuation of this. Anyway, that's my trading plan for the next few weeks and for the next few days. Have a great week, and I'll talk to you next week. And take care.